Hi, this is estate planning lawyer Michael Pevney, and I create estate plans for families. And in this video, I'm going to talk about, do trusts pay taxes? And unfortunately, the answer to this is a very lawyer answer, and the answer is it depends. It depends on the type of trust. Normally, for most of my clients, we create an estate plan, and that estate plan is centered around a central estate planning document. That's called a revocable living trust. When I create a revocable living trust, let's say we're talking about a married couple, both members of that couple would be the initial trustees. And it's also revocable, meaning it can be changed or revoked at any time. Now, because it's both revocable and created while the initial trustees and the trustors are alive, that trust will not pay taxes because there's very little difference in the eyes of the IRS or whatever state tax agency we're talking about between the trust and the people that created the trust as individuals. There's very little difference. The income, if income comes into a bank account that's owned by the trust, because it's a revocable living trust, the trustees are going to pay basic regular income tax as if they are individuals. Now, that can change when oftentimes a revocable living trust, if both of those people that created the trust, both of those members of the married couple pass away, and the beneficiaries are still alive, and money needs to be paid for them. Maybe it's kids that are younger, or it's kids that we don't necessarily want them to have a huge chunk of money at one time for various reasons. So money still exists in that trust, but when both people who created that trust die, the trust goes from revocable and it becomes irrevocable, meaning we can't really take money out of that trust unless it's following the terms of the trust as it was initially created. So those assets in the trust might be assets that earn money. You can even put up business inside of a trust that earns money. It can be invested in stocks, bonds, mutual funds, crypto even, and to the extent that the trust and the investments in the trust earn income, tax has to be paid on it. And the tax rate for a trust is high. It basically jumps up very quickly with very few exemptions to the highest income tax rate at the federal level. So income taxes on an irrevocable trust are quite high. And that's always a little bit of a balancing act to go through with clients, and we need to balance the tax rate once that trust becomes irrevocable with the control that you want to have over that money. Because a trust provides a lot of control over how things are distributed to beneficiaries. And let's say our married couple pass away and they have a couple of kids. Do they want to have that money that's in there distributed outright to the kids when they pass away? Or do we only want it distributed under certain conditions? Because a trust can provide for, in that situation, a lot of asset protection, especially if we're dealing with maybe a child that's had substance abuse issues, maybe a child that's going through a bankruptcy, maybe a child that is going through a divorce. And if we want those assets protected, it's oftentimes better that they remain inside of that trust, even though that trust may be paying taxes at a higher rate. And that is just a basic overview about whether or not taxes are assessed on trusts. So when it's a revocable living trust, no taxes, it flows right through to the income of the individuals. But when it becomes irrevocable, yes, there are income taxes, but we have to balance that against the control that the people who initially set up that trust want to have over that money. So if you have any questions about this or anything else related to estate planning, you can set up a time to meet with me for free by going to ocestateplanlawyer.com. Thanks for your time and thanks for your attention.